Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we warned viewers that we would be having an educational show this week. We're still in the same clothes. So indeed, it is going to be an educational show on stop losses and just the importance thereof, given some of the trades that you've put on for the portfolio this year.
Yes, that's right. I mean, one thing that I think I'm proud to say about this show in the nearly 8 years that we've been doing it is that our risk management has always been impeccable. And it's one of the main reasons that I attribute the success of this show to. And this year, 2017, hasn't been an easy start to the year. We now sit at the end of April, early May, and we've completed 8 trades with another one that's open. In fact, another 2 that are still open. So effectively, we've done 10 trades for the year, but 8 of them are completed with a result. And out of the 8 that we've completed and that we've closed, only 2 of them have been winners. And 6 of them have been losers. So effectively, that's not good. I mean, if you think about the goals that I set out for myself at the beginning of the year, where I aim to try and get 2 out of 3 trades right, well, we're clearly on the wrong path as far as that goes at the moment. We've got 75% wrong and only 25% right. But having said that, we are still up for the year. If you take our 2 portfolios together, the rand-based portfolio and our offshore portfolio in pounds, you can see the stats that are up on the screen here at the moment. Overall, we're up 4% for the year to date. So certainly not shooting the lights out by any means. But what I want to talk about today specifically is the importance of the stop losses and the importance of risk management. And just to illustrate how significant that has been to our performance this year to date. Because although those numbers don't look good, 6 losers out of 8 is not fantastic at all. Yet we're still making money. And it's because of the risk management and because of the fact that we've stuck to stop losses and kept our losing trades very, very small.
I mean, this is something fundamental, I think, that you have to appreciate once you start trading, and even as an experienced trader, is that it's not only about the big hitters. So, and you're never going to get all your trades right. In fact, you're an experienced trader. You've been in the market for ages. And we can see from that performance that things aren't going that well. But you can make money even by not picking, the best shares of the bunch all the time.
Yeah, that's the thing. It's about keeping your losers small and trying to maximize your winners. You could find professional traders out there in the world who maybe only get 30% of their trades right, but still make money because they let their winners run and they keep their losing trades very, very small. So it's about proper risk management. It's about sizing your positions correctly and never letting a loss get out of hand. And that's, as I was saying, I'm proud of the fact that we've never let a loss get out of hand on this show. In the 8 years nearly that we've been doing this show, we've never ever never dropped the ball in terms of letting a loss get out of hand.
Yeah, and it can be quite tempting, and maybe we'll talk about that in a moment, not to let a loss get out of hand, but just to maybe ignore one's own principles when you're trading.
Yeah.
But that histogram essentially shows the trades that you've entered into this year.
Yeah, so that's it. So I always like to measure our trades on a histogram, and generally we only do this in the middle of the year and then at the end of the year and have a look back. But it's quite instructive to do it right now because of this exercise. And just to illustrate, it hasn't been easy. You can see we've only had 2 winning trades there. The first one was in Royal Bank of Scotland, which was our first trade of the year, where we made a bit of money. And then the other one was a more recent trade in Naspers, where we made 8.2% of capital as a return. But the way this histogram works is the red bars indicate the amount of risk that we assumed on each trade. So you'll see we never risk more than 2% of our capital on any individual trade. And all of those, and we do that by setting our stop loss at a particular level and then sizing our position in such a way that if we are wrong and we get stopped out, then we won't lose more than 2% of our capital. So you can see all of our risk assumptions there have varied between 1% of capital and up to 2% of capital maximum. Now the green bars are the result. So obviously you want a positive result, like we saw with Royal Bank of Scotland, and particularly like we saw with Naspers, where you get a nice big tall bar to the upside. When you're wrong, you want to have small stubby little bars to the downside. So those green ones to the downside are indicating the losing trades that we took. And you can see in all those cases we were quite diligent about sticking to our stop losses. The loss amount pretty much corresponded with the amount of risk that we were willing to assume on each trade. If the loss was ever slightly bigger than the actual risk assumed, it was usually because of transaction costs and because of a little bit of slippage in executing the stop loss.
Yeah, and what you mean by that is you have manual stop losses. You
Yeah.
don't have automatic stop losses.
Yes.
So I guess if they were automatic, you probably wouldn't have slippage because you're probably not sitting in front of your trading screen all day.
Correct, that's right. But even then, you would still have some transaction costs. But the point that I want to make, and we'll come back to this histogram just now and show you how it could have gone so much more wrong had we not been disciplined. But what I want to do now is have a look at a number of the trades. In fact, I'm going to focus on 5 trades that we've done this year in 2017, and particularly the losing trades.
Okay.
And I mean, we always like to keep it honest on this show. I think viewers know that. And I'm going to say it outright. I think I'm here to brag about our losses this week, which sounds like a weird thing to say. But I am here to brag about our losses because had we not stuck to our stop losses, things might have gone a hell of a lot worse for us on a number of these trades, and particularly these 5 trades that I'm going to show you now. So yes, we are here to brag about our losses, and sometimes a losing trade can actually be a confidence-building experience.
Yeah, well, I'm glad to see that you're looking on the bright side of life. But I don't mean to diminish in any way the importance of this message. Okay, so let's go through those trades.
Yeah, so this is a trade this is one of our earlier trades from the 24th of January. It was a long position in MTN. At that stage, what I saw was a falling wedge pattern, which I figured was likely to break to the upside, and that would see the stock moving higher. It did indeed break to the upside, and it looked very good for a few days, and then the share price promptly came down. And then it triggered our stop loss. So we got out at 124 Rand, where our stop loss was, and we lost 1,145 Rand, so about 1.1% of our capital. And that's that. We went into the trade knowing that that was one of the potential outcomes, and if it went below our stop loss, we would exit and walk away from the trade. Now, you can see what happened since then is that share price continued to fall a lot further. And if we had not stuck to our stop loss, then that could have actually gotten quite ugly for us. So in this case, most definitely the stop loss was successful in terms of managing our risk and helping us to protect our capital.
Because there's always a temptation to ignore a stop loss, isn't
there?
there?
Yes, there is.
Because you think, no, I know I'm right in this trade. It's going to work out.
Yeah.
And then the hope starts kind of taking over versus the reality of the situation before
Correct.
you.
You know, I've been doing this, I've been trading since I was 16 years old, and I've been in a broking business since I was 21 years old, seeing how retail traders trade. And amateurs, and I don't mean that in a derogatory way, but seeing how amateurs trade their accounts, and so often that is the case, that a stop loss gets ignored because people don't want to take the loss. At the end of the day, nobody really wants to lose money. And what so often happens is then you ignore a stop loss, or you kind of think, I'm going to let this one slide and it'll be okay. And then it gets worse and worse and worse. And then you also suddenly end up in a situation where you're really deep in the hole, and then you start wanting to do silly things like averaging down and making your losing trade even a bigger problem for yourself, which is a really bad habit.
Okay, so that was MTN and could have gone horribly wrong.
Yeah.
What about some of the others?
Then this is BHP Billiton. We did this trade on our offshore portfolio, so BLT is the code of Billiton in London. And at that stage, what I saw was that the share price was moving higher. There was a wonderful uptrend evident, and that uptrend actually goes back even further to the beginning of 2016. Very well-defined upward trend that was in place there. We saw it reversing up off of that upward trend there in early February. So I went long of 220 CFDs at £13.60 with a stop loss of £13.15. Now, as it turned out, the stop loss was triggered again, and the share price has subsequently moved even lower. We got stopped out at our level of £13.15. We lost £112, so again, about 1.1% of our capital. And again, had we not stuck to that stop loss, you can see the share price has moved even lower in the subsequent weeks since then. So things would have also gotten quite a lot worse if we didn't stick to our stop loss over here.
Yeah, I mean, this is a recurring theme. What about some of I think there's 3 other charts.
There's still 3 others, yeah. So this one is Weir Group. This is also done on our offshore portfolio in London. And at that stage, what I'd seen, this trade was also done in early February. I saw the stock trading in a sideways range. It broke to the bottom of the range, then reversed back up into the range. And often when you get a false break out of a range like that and then a move back into a range, it usually breaks out in the opposite direction. So I looked at that and I thought, well, that's probably set up for another move back out the top of the trading range here. Anyway, I was wrong, and we went long at 170 CFDs at £19.79 with a stop loss at £19.20. What you can see is that stop loss was triggered, and we actually had an auto stop loss here because I was away at the time. So fortunately, the auto stop loss caught us before this massive drop came, and we only lost £113 here. So again, 1.1% of our capital in London. Not the end of the world, and it would have become a lot worse had we held on a few more days there.
Yeah, I mean, I know a skeptic might look at that chart though and say, okay, but only if you'd crystallized your losses at the lowest point in that chart,
Yes.
whereas now it's trading actually above the entry point.
Yes, only just. But that's easy with hindsight. You see, we don't know. I mean, that move lower might have been the start of a much bigger move lower. And you don't always know that as a trader. So with every trade that you go into, you need to go in with a defined stop loss and know that you're going to execute that stop loss if it gets breached, without question.
And the two other losing trades, Garth?
So this one was GlaxoSmithKline. This was a more recent trade which we did in the middle of March. So what I'd identified here was that the stock was trending nicely higher. I saw that as an ascending triangle pattern that was busy forming over there. And usually when you get a pattern like that, you would expect it to break out to the upper end of that pattern. So I went long at £16.86 with a stop loss at £16.65, and it ended up coming down and actually breached that stop loss. So I closed it at £16.63. We lost £150 there, so 1.5% of our capital was lost. And then if you look at what happened in the weeks since then, and particularly this past week, where we've seen the pound strengthening quite dramatically, that's weighed on the share price of Glaxo quite significantly. So that would have become a much bigger problem for us had we not stuck to our stop loss and executed it like we did.
Yeah, I mean, and the previous charts, this chart is an indication that you have absolutely no benefits of hindsight when you're looking ahead. So and if you'd had prognostication powers, you'd have got out when you did. And then the last chart, Garth.
Last one is a local trade in Grindrod, and here I was also looking at this stock bumping up against overhead resistance here at 14.70 Rand. And I figured it looked like it was bumping up off that 50-day moving average, and the Rand was weakening at that point in time. And I felt that Grindrod looked as if it was poised to break out to the upside through that overhead resistance. And I think what I did wrong here, and also with the previous trade in Glaxo, was I preempted a break, whereas possibly I should have rather waited for the break. And there's a lesson in that as well. Trying to preempt breaks can sometimes be dangerous. In any case, we went long of 960 CFDs at 14.38 Rand with a stop loss at 13.90 Rand. The stop loss was breached, and you can see we lost 566 Rand, so 0.5% of capital, not a problem there. And look how much further that share price has fallen in the weeks since then. So again, the stop loss really saved us there.
So if we go back to that histogram on how it could have looked if you'd ignored your stop losses.
Yeah, so I've reconstructed that histogram now with assuming that each of those losing trades actually went to their worst case scenario that we've identified in each of these charts. And you can see, look now, we've got these big downward spikes to the downside on those losing trades then, particularly those 5 that I've highlighted over there. And look at what would have happened to our portfolio performance. We would have been down 11% for the year to date versus being up 4% for the year to date. So the swing factor, remember we're up 4%, minus 11%, 15% of capital is the swing factor. And we're talking about only 3.5 months of trade here. That's what stop losses effectively have done for us. They've improved our performance by that much. It could have been much, much worse if we weren't so diligent with the stop losses.
And of course, you will start to feel a hell of a lot more desperate when you're down 11%. And that can also affect your trading game because maybe you do silly things or take kind of riskier positions.
Yeah, that's right. When you're down that, and it's difficult to recover from that. And that's the nice thing. We always keep our losses small, so we never see big drawdowns on our capital.
Yeah. Garth, I've sort of run out of time, but very quickly, you've got a couple of courses coming up this month.
Yes, in May, I've got in Joburg on the 11th of May and the 13th of May, I've got courses, and then in Cape Town on the 27th of May. Anyone that would like to attend any of those, please email me, garth@traderscorner.co.za, and I'll send you all the info.
Great, we'll leave it there. Garth, thanks for joining us as always. Garth McKenzie is founder and editor of Traders Corner.